makers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone. This is The Pulse. Now, President Donald Trump has weighed in on DeepSeek's breakthrough at a Republican Party retreat in Florida. Now, he welcomed its arrival, but also delivered a warning.
The release of DeepSeek AI from a Chinese company should be a wake-up call for our industries that we need to be laser-focused on competing to win.
Well, let's bring in Bloomberg's EMEA News Director, Roz Matheson. Roz, we'll get on to, of course, some of the DeepSeek news that really roiled markets in just a second. But Donald Trump was also quite clear on wanting to introduce tariffs on certain industries. I'm not sure who they're levied to or whether he'll actually come through with it.
Well, that's right. This is all this sort of noise around will he introduce tariffs, when will he introduce tariffs, how much will they be, and how quickly will they move. And obviously we reported earlier this month that there were a number in Donald Trump's inner circle, including Scott Bessent, who's the incoming Treasury Secretary, advocating for a gradual approach, like maybe starting with a number between 2 and 5% and then going up on a monthly basis. So you want to see whether, countries respond to that initial tariff, that blanket tariff, and then how can they negotiate from there. And so further signs again overnight that might be what Scott Bessent wants. But clearly the message each time from Donald Trump on the back of that is, hang on, I'm looking at some pretty serious tariffs here. And he really wants to keep that option open. I mean, even if they end up with gradual tariffs or no tariffs at all, he wants that as a tool of leverage right now. He wants that hanging over people. You can see that's why the market is kind of whipsawing around quite a bit. But it's clear he wants that in the toolbox. And we saw from the example on the weekend of Colombia that he's very, very willing to use it if need be.
But Ross, so I know it's difficult to find a Trump whisperer to really understand how far he's ready to go, but he's basically saying to the pharmaceutical companies, look, he wants to compel them to bring manufacturing in the U.S. So if a company says, I'm going to add, 5,000 jobs to the U.S., is that enough? Do we know what the threshold is, or is it just impossible to tell?
Well, certainly you want to show that you're doing something, be it building factories, bringing jobs back. And if you can make that number as big as possible and make it sound really good, the better. I mean, we saw Saudi Arabia recently pledging to spend a lot of money in the US. How much of that is real or feasible? Perhaps it doesn't matter because it's a really big round number with a lot of zeros after it. And that's what really counts in the end. So if you're a company, what you do want to show is either talk up your existing manufacturing there, show what you're already doing, and then add on to that. I mean, you can promise factories that could be built in the next 5-10 years and don't have to necessarily eventuate if you're really wanting to try and manage Donald Trump on it. But it's about just showing him that you are listening to him is the key.
Roz, I keep on hearing that, the last 10 days were frankly a whirlwind in terms of executive orders, in terms of policies. I mean, will this administration have to slow down? Does he have the team around him now put in place? How do you see it going in the next 2 months?
Well, obviously he wanted to demonstrate a lot out of the gate, and he was doing that even with some of the things he was announcing and saying overnight. So he's obviously trying to move what he sees as democratic officials out of the, the machinery of government, out of the bureaucracy, out of different ministries. He's got work to go there. He wants to demonstrate very much on the immigration side, so he's pushing on migration. But, he's trying to do a lot in quick succession. At some point you do need to do these things, have they had an effect? And then go on. But obviously he is trying to demonstrate he's as good as his word on a bunch of things.
Roz, thank you so much. Roz Matheson there, our EMEA News Director. We also had a conversation with Keir Starmer, the Prime Minister of the UK, on tariffs, on trade, and how dealing with Trump, or what that will look like in the next 5 to 6 months. So we'll bring you that interview very shortly. In the meantime, Nvidia has called DeepSeek an excellent AI advancement. OpenAI Sam Altman has praised its model, and President Trump says it's a wake-up call for the U.S. Now, the Chinese startup has upended global markets with Nvidia's drop, the largest ever one-day loss in market history. Now, the release of R1 has sent shockwaves through the U.S. tech industry, leading to re-evaluation of the economics of the AI investment boom. So let's get more with Robert Lee from Bloomberg Intelligence. Robert, I mean, there's so much copy in saying, well, actually, they do have some of the Nvidia chips that they're not supposed to have, or maybe they do or they don't. I mean, is this just a turning point for the AI sector? And what do we actually know?
Okay, good question. We don't really know on how much inventory they've got access to. We don't really know if these claims on cost down, the sort of approximate $6 million, are correct. I mean, on one hand, it seems almost too good to be true. But what we do know is the performance of their models is amongst the best in the industry. On some external benchmarking services, in fact, benchmarking websites run out of the US, DeepSeek's models have ranked number 2 globally. So the evidence is there that they have a highly effective and efficient model. I do think there is truth in the cost down claims, and also they've been extremely aggressive on the pricing that they're charging their customers. So I think that ultimately the story does hold together. Some of the details perhaps not so. And coming back to your question, this is a turning point in the industry. Who am I to argue with President Trump? I think it is a wake-up call. Whilst people in Asia had been familiar with DeepSeek for some time, clearly that isn't the case in terms of financial markets, given the reaction we've seen. And I think, as they always say, there's no room for complacency. So this is a wake-up for the big tech platforms, and we'll have to see how they evolve their model and their business plans on that front. Maybe they move to smaller, lower-cost models going forward. I think that's probably the direction of travel for the industry from here.
So, Robert, is this the biggest challenge it's faced? And actually, are there any security, national security concerns? Again, I think, there's a clause in saying that the Chinese government has access to all the kind of modeling that Chinese AI uses.
Yeah, there's always a national security concerns on both sides. You'd be concerned if a potential rival has access to sensitive consumer data. But I think the big question mark and the big challenge for the industry remains the same: monetization. Looking at the US tech platforms, they're spending tens of billions on capex per quarter. I still think that fear of missing out is driving a lot of the decision making on the capex front. I mean, we saw what Meta had to say at the end of last week. And whilst companies are beginning to monetize, I'm still of the view that they're not monetizing anywhere fast enough, and the absolute level of monetization remains very low. If you did a straw poll of people in your studio now, or even amongst the viewers watching this, I do wonder how many people are putting their hands in their pockets and actually subscribing to these AI services at the moment. I'm sure we've all played around with them, had a little bit of amusement, this, that, and the other. I'm not saying that they don't have a real use, but the majority of consumers at the moment don't see that there's sufficient value add for these products, and that is a major barrier to monetization, particularly when you're a big platform shelling out tens of billions a quarter. So I think there is a potential day of reckoning coming at some point later the year, where the more marginal players in the industry physically won't be able to continue to afford such high levels of capex. I think the large tech platforms should remain okay, because obviously they benefit from very strong internal free cash flow, and most of them are sitting on extremely strong balance sheet. But equally, that just prolongs this cycle. There's an awful lot to say on this, but hopefully that answers some of your question.
Rob, so interesting. Thank you so much. It was interesting, actually. I thought in Davos, a lot of the bankers used it a little bit more for personal reasons than, people, for example, in the newsroom. Rob Lee from Bloomberg Intelligence answering some, very important questions as we're trying to figure out what happened over the last 3 to 4 days in the markets. Coming up, we'll continue discussing the market fallout from DeepSeek's emergence and much more with Thushka Maharaj, global strategist at multi-asset solutions at JPMorgan Asset Management. Plus, a little bit later in the show, our interview with the UK Prime Minister Keir Starmer as he lobbies chief executives at some of Britain's largest companies here at Bloomberg's European headquarters in London. This is Bloomberg. Now, the dollar strengthened after U.S. President Donald Trump said he wanted much bigger universal tariffs. Let's get more on the latest market moves with Thushka Maharaj, global strategist and multi-asset solutions at JPMorgan Asset Management. Thushka, thank you for joining us. I mean, there's quite a lot of market turmoil, whether it be the tariffs, whether it be the latest we know with DeepSeek. Is this going to be volatility for 2025?
Good morning. Yes, thanks, Francine, for having me on. Yes, we agree there is volatility in these markets, and especially, as you say, with the new administration in the US. We've seen in the last few days quite a lot of news flow on tariffs, and we think that that will keep uncertainty high. But it's not a reason to prevent us taking risk. And I think yesterday was a good example of the market having had a shock in terms of tech, the tech sector and tech innovation, which I think is a welcome development. But what was interesting was that 70% of the S&P still ended up in positive territory, and the equal weighted index ended up positive. So I'd say that theme of broadening out of growth, that theme of broadening out of earnings, is something we're watching this week and into earnings season. But I'd say that was reinforced post even in the volatility.
Yeah, and Thushka, I mean, we've been talking about some of the Magnificent Seven being priced to perfection. Is this just case in point?
Well, I do agree with the point that valuations and that concentration of the S&P has been a focal point. I do see yesterday, or at least even though we don't have full information, I'd say yesterday was an example of the market using a catalyst and then high valuations as an accelerant for what happened, and positioning, as you say, was already quite long in the tech sector. I wouldn't necessarily say that this is a start of a more prolonged sell-off. We need more information to form a bigger view. But what I would say is that disruption and innovation in the sector is something we should be more comfortable with. And to your point about higher volatility and higher risk premia in equity markets, I think that is something we're going to have to deal with. But ultimately, when we think about this from a big picture perspective, we see this innovation as helping bring down the costs of training, the cost of usage, and this will help broaden the availability of AI to other users of the technology. So when you think about that Jeevan's paradox, more usage, more demand for AI might actually support the tech sector more, given this innovation.
Thushka, what are you expecting for earnings season? Does it give us, is it, I guess more anxiousness as we look ahead to possible U.S. policies, or you expect to have a robust quarter?
Yeah, so this week where we have over 30% of the S&P reporting, I think it is going to be quite informative. It's taken on a new connotation in the last 24 hours, watching spending, CapEx spending, especially by the big tech sector. But I would say that we have confidence in strong earnings delivery across the board. But what we're watching most closely is the broadening out theme. So last year, the idea that the Mag 7 delivered 40% of earnings. This year that's likely to come down to about half of that, whereas the rest of the S&P, we're likely to see more than a triple-fold increase in their earnings expectations, going from 3% last year to expectations closer to 13% this year. And I'd say it's that second component we're watching very closely, both in terms of margin growth, but also that broadening out of earnings and confirmation that the rest of the S&P can outperform consensus expectations, I think would be a very strong positive for equity markets at this point. But as you say, we are watching what happens with the response of the large tech stocks to the news flow in the last 24 hours, and their intentions on CapEx, I think, will be a hyper focus for the market in this week's data.
Thushka, when you look at euro area growth, is it slowly bottoming out? I know there's been so much, I guess, discouraging news from Europe. At what point does it bounce back, and what does that mean for equities?
Yeah, we've been watching this quite closely. I'd say it started in the early part of December, where the PMIs in the euro area were starting to show some signs of improvement, and now we can't lose sight of the fact that they're improving from a very low base, and so yes, we've used Europe in the past as a funding market, but we're quite conscious that that's consensus, that the market's pricing in that negativity. And I'd say in the first few trading sessions of this year, we've seen strong performance of the European equity market. Part of that a reflection of the valuations relative to the US, the cheaper valuations relative to the US, but part of that bottoming out of the PMIs, and the recent data have been more encouraging. What we're watching to build momentum in this view is more the outlook on the political front. You mentioned tariffs being an uncertainty, and I think that will hang over confidence and business sentiment even in the euro area. But more importantly, we're watching the German elections. in the middle of February, where the likelihood of seeing more fiscal spending, more domestic fiscal spending that's targeted either at investment and infrastructure or helping with welfare costs as well. So that that I wouldn't call that necessarily a game changer, but could that be another catalyst for more optimism in the euro area? I'd say yes. That's something we're looking for.
Thushka, I mean, what would be a game changer? I guess is a softening from the Trump administration on China. Again, I don't know if that happens. There's been, a couple of sounds maybe on that in a TV interview that could quickly be reversed. But what are you expecting from China and some of the Trump policies?
Yeah, well, what could be a game changer? So I think, yes, one of those avenues could be the softening of tariffs, the usage of it more as a negotiating tactic rather than something more punitive. But I would say for the euro area, what's more game-changing would be the idea of a relaxation of the debt brake in Germany, where you could see more spending either through the Conservative or the Social Democrats, a coalition creating more spending in Germany. What could be a broader game changer for risk markets? It would be a Chinese policy response that's larger than consensus today, alongside a softening from the Trump administration. But I would say that, broadly speaking, the news flow over the last 24 hours has given us more confidence in this idea that innovation and disruption in the tech sector will ultimately lead to a lower cost base, which will bring in more users of that technology. And ironically, we see that as being quite supportive for growth over the medium term, and not just in the US. I think that's the crucial difference.
Thushka, thanks so much, as always, for joining us. Thushka Maharaj there, global strategist of multi-asset solutions at JPMorgan Asset Management. Now, coming up, we'll hear from Black Swan author Nassim Taleb on the recent rout in U.S. tech stocks following the emergence of DeepSeek. Plus,
well, the number one priority of this Labour government is growth. And by that I mean wealth creation, and that's why what you've seen in recent days is a number of announcements about how we're going to strip away regulation, strip away the inhibition of planning, use AI to take us forward. And so today we've had the opportunity across a number of sectors to have a really good discussion about how much further we can go. But the number one mission is wealth creation. We have to get our economy working. I think we're beginning to see how that's turning around, and we'll build on that as we go forward.
Our interview with the UK Prime Minister Keir Starmer as he lobbies chief executives of some of Britain's largest companies here at Bloomberg's HQ in London. This is Bloomberg.
It shows the fragility of the wealth formation based on a very small number of stocks causing it. Okay, how much of wealth formation came from Nvidia? 3 trillion capitalization. A lot of it is recent. Okay, so it shows us how much the whole economic structure is fragile because of that.
That was Nassim Taleb, the senior scientific advisor at Universa Investments and the author of Black Swan, speaking about the steep sell-off in Nvidia stock and the market's fragility. Now, also making news, President Donald Trump says Microsoft is in talks to buy the U.S. arm of TikTok. Now, other bidders so far include AI startup Perplexity and billionaire Frank McCourt. Microsoft and Oracle were in the running to buy the app in 2020 when Trump first pressured Chinese owner ByteDance to sell or face a ban. Coming up, our interview with the UK Prime Minister, Keir Starmer, as he lobbies chief executives at some of Britain's largest companies here at Bloomberg's European headquarters in London. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The Prime Minister, Keir Starmer, tells Bloomberg the UK economy is starting to turn around, and he'll meet President Trump soon. Our interview coming up. Nvidia claws back some ground after its $589 billion rout, the largest in stock market history. Plus, DeepSeek's competitors respond to the Chinese AI disruptor. Nvidia calls its new model excellent, while Sam Altman welcomes the competition and promises more from OpenAI. So the UK plans to unlock billions of pounds to help drive economic growth by allowing companies to invest surpluses from pension funds. Now, it comes with the Labour government under pressure to boost sentiment after its tax-raising budget last year. Well, speaking this morning with us here at European headquarters in London, the Prime Minister Keir Starmer and the Chancellor Rachel Reeves have been lobbying chief executives at some of Britain's biggest companies for support. Well, the Prime Minister spoke to us after the meeting, saying the UK economy is beginning to turn around.
Well, the number one priority of this Labour government is growth, 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 growth. And by that I mean wealth creation. And that's why what you've seen in recent days is a number of announcements about how we're going to strip away regulation, strip away the inhibition of planning, use AI to take us forward. And so today we've had the opportunity across a number of sectors to have a really good discussion about how much further we can go. But the number one mission is wealth creation. We have to get our economy working. I think we're beginning to see how that's turning around, and we'll build on that as we go forward.
Prime Minister, how do you look at, of course, tariffs? You had a very productive call with President Trump. He's going after the EU in terms of tariffs. Do you worry that he'll go after the UK next, and how do you straddle that?
Well, I had a very constructive call with President Trump over the weekend, very positive. And of course, there's a long history between our two countries. It's a special relationship. We've fought together in wars. We've worked so hard on security and intelligence together. And there's a huge amount of trade between our two countries. I think that's to our great advantage. I think that's something that we can build on. And so I was very pleased with the engagement that we've had with President Trump. We'll build on that.
Yeah, so do you think tariffs can be kept at bay?
Well, we will work constructively with the US. Look, we've got a huge amount of trade between our two countries already. So the base there for even better trading relations, I think, is already there. We need to build on that. And that's the mindset that I bring to this. It's the mindset that President Trump brings to this.
Prime Minister, on Greenland, do you think it has to stay part of Denmark?
Well, I'm not going to comment on issues that are not central to what I have to deal with in relation to the UK and the US relationship. It's a special relationship. It's been there for a very, very long time, and there's a shared intent between myself and the President to build on that.
The UK Prime Minister Keir Starmer speaking at Bloomberg here, of course, in London a short time ago. Now let's bring in Philip Aldrich, our senior economics reporter on Bloomberg's John Stepek, author of the Money Distilled newsletter. So thank you both for joining us. I mean, look, there was market turmoil. There was a lot of question marks about how the UK was going to achieve growth, whether the budget was a mistake. Are they now trying to recalibrate and get back on message with business?
Well, they have always said that growth was, the priority because they had this 2.5% target by the end of the Parliament, and they want to be the fastest growing major economy in the world, even faster than the US. So the budget seemed to be all about raising the taxes, fixing the fiscal position, and obviously it annoyed a lot of businesses who were hit with this £26 billion tax. So I guess they are trying to bring back, what is the agenda for growth? Because that was the piece missing. It was not a budget for growth. It was a budget for, basically big taxes. Rachel Reeves has got a big speech tomorrow on Wednesday, and they've already unveiled these kind of, effectively they're saying we want to go for deregulation, we want to, just bulldoze through the planning rules, and they are trying to release money through the pensions system to get investment into the UK, because as Starmer says, growth to him means investment.
Yes, growth, everything's better with growth, right? Let's start there. Of course, if you have growth, you're fine with your fiscal plans. And John, Phil wrote this great story on basically it's the pension surplus that gets reinvested. We're talking about a third runway at Heathrow and potential expansion in other infrastructure projects. I don't know where we are on Sheen. Is this enough to get the kind of growth that the UK needs, especially if you're competing with the US?
Absolutely. I think it's a good idea to go for growth. We've definitely been held back by planning issues. Heathrow's been sitting there the third runway's been around for, decades, and it's been signed off a number of times in the past as well. So the thing that's going to be the real, obviously, test of this is whether they actually get it past the Cabinet. I do feel that one issue is that, the budget came out, and beforehand they'd sort of talked about growth, but obviously what happened was they actually slapped the private sector in the face with this big tax on employment. And that is not something that you do if you want to encourage growth. You don't make it harder to employ people. And we have seen the effects of that feed through in the data. And I feel that what has happened here partly is that Rachel Reeves in particular has seen how vulnerable the UK is. The bond market turmoil was not her fault, but not having enough space was arguably her fault. So she's kind of left herself between a rock and a hard place. And the only way out now is growth. No, they can't do further tax raises because they've seen what happens when you do that. But they also are going to struggle to push through public sector cuts because, it's going to be very difficult for this government to leave itself open to accusations of austerity after it spent the last 14-odd years complaining about Tory austerity. So I think, in a way, this is the only way out that they see. And that, to be fair, that's a good thing because we need growth. We desperately need growth.
But I guess, Phil, there were so many questions about whether the Chancellor could stay in her job after the market turmoil. Is this going to be a kind of a new Labour policy? So if they don't have the growth, will they have to go back for the, spring statement and change some of the things that they announced in autumn?
So the growth isn't going to come through
now
in time. Right. Yeah. So actually, at the last count, the economy is smaller than when Labour came to power. And all the sentiment indicators have remain miserable, basically, among both consumers and businesses. So they've got to basically shift the dial. I guess if you get confidence and a big morale booster coming, then that helps. And telling businesses that there is going to be a degree of deregulation, and there have already been specific policies announced actually on planning to make it a lot easier to get building and developments off the ground. And they are announcing projects which have been, there's a whole bunch of stuff that's just sitting on ministers' desks and hasn't been given the green light. And actually, Angela Rayner has been one of the more active members of the cabinet getting stuff through in the housing and building department. But the it really, on the actual day of the March 26th, when the OBR comes out with its new forecast, it's entirely plausible that Rachel Reeves has got less than zero headroom, and she has to find extra policies, and that is going to be a difficult one for her, as John was saying. It looks like welfare may be something that they tried to go after as a priority.
John, are they still very vulnerable to market turmoil? Again, this was originated in the U.S., but this is a small open economy, huge borrowing, kind of dependent on the kindness of strangers. The kindness of
strangers, yes, the old catchphrase. Yeah, I mean, I don't, people have been very doomy and gloomy about it, and I don't think it's that bad. But the problem is, if interest rates do go up in the UK, then obviously, for a start, it kicks the housing market back. I mean, the housing market is a big driver of the wealth effect and how healthy consumers feel in the UK. And also, I mean, I think, so if you get interest rates kind of heading higher, then it doesn't, well, again, it kind of puts the Chancellor on the spot. I do think one problem is this, the problem is this insistence on following exactly what the OBR does. And again, they've sort of learned some of the wrong lessons from the Liz Truss kind of episode. I feel that the OBR is kind of enshrined too much, and I think that the Chancellor should feel a bit more free to say, actually, we're going to pursue this, we're going to pursue this growth plan, we're going to give it room to breathe. But that's, again, politically difficult because of the corner they've backed themselves into.
Phil, the hardest question you'll ever get from me is how do you think this government measures success? Like, what do they need to, how do they think we've done a good job here?
Well, so, I mean, I think their guiding, principle has been, to fix the public services effectively, and it does come back to growth, like you're saying. Growth cures everything. So if they can get the NHS working, they can get social care functioning. The local authorities are all bankrupt practically. If they need to get to the end of this 5 years and show, one, that the economy is working, but two, that the people's living standards have improved. So continued increase in real wages and public services that function. I think that's what's going to happen. That's what they're going to be measured on, above all. Yeah.
Thank you both for joining us. Phil Aldrich there and John Stepek on the very latest from the UK. Now, coming up, we'll have more on how DeepSeek has sent shockwaves through the tech industry. That's next, and this is Bloomberg. Well, Chinese startup DeepSeek has upended global markets as its cost-efficiency AI model is likened to that of OpenAI in terms of capabilities. Now, the release of R1 has sent shockwaves through the U.S. tech industry and posed significant challenges for Nvidia. Let's get the view now from Ipek, Ozkardeskaya, senior analyst at Swissquote. Ipek, thanks so much for joining us. Does this change everything for AI, or do you have many questions on the Chinese model?
Well, actually, it does not change everything for AI. So first of all, I think that everybody should calm down. What we saw yesterday, the market rout, was obviously amplified by the high valuations of the US AI stocks, also the existing worries regarding the massive cost of investing in AI and the unsatisfactory return on investment so far, especially last year. But looking at DeepSeek, we have a lot of unanswered questions out there, including whether the DeepSeek's model is integratable, for example, with the other applications. We will see that very soon, reportedly from February. But we don't even know if they really built a model of less than $6 million as they say they did. What we understand is that the DeepSeek company they use a lot of Nvidia chips, cheaper Nvidia chips, but Nvidia chips still, to build their model. So the simple idea that we could do a performant AI model at cheaper price is obviously waiting on the revenue outlook for many chip companies out there. But I think that it's very early to talk about a threat on the AI dominance and a game-changing model from DeepSeek.
Yeah, and Ipek, I guess, I mean, you say it very clearly, right? It basically brings, you think, an equal performance just at a cheaper price. What are the market implications of this? Are we going to see more demand for some of the cheaper chips? So Nvidia loses out, others gain.
Well, first of all, the idea that we would see a growing demand for cheaper chip makers was already there. So the idea that someone could create a well-performing AI model with cheaper chips only strengthen our conviction that this will be happening probably sooner than we thought. But looking at Nvidia, a company like Nvidia is putting out the world's best performing chips, and they're basically selling these chips to the world's biggest technology companies. And these biggest technology companies make up to 50% of their revenue in the third quarter of last year. So basically, these companies are probably not going to settle for cheaper chips because they're looking for disruptive innovations. So I think that Nvidia itself, the high concentration of these big technology companies in Nvidia's client book, will probably now be all of a sudden a good thing for Nvidia that could help the company weather a potential demand shock for its expensive chips. And for the other companies, I think that the fact that the idea or the possibility of making well-performing AI models at cheaper prices will simply increase and accelerate the adoption of AI, and it's going to increase the demand for chips. Maybe not Nvidia's high-end chips, but chips still.
Yeah, and Ipek, I guess one of the other questions is that, we've long heard that some of the big companies want to do their own chips. So if there's a way of doing the same models with cheaper chips, is it easier for some of the big tech to go into that space and win?
Well, I think that one of the biggest threats for Nvidia, rather than cheap chips, is the possibility of these AI companies, the ambition of the biggest technology players like Google, like Meta, to produce, to build their own chips, as you say. And in that sense, we really think that, yes, it would be a great thing if they could do that on cheaper chips. But it would be even better if these companies that do have the means to do the best of the best could do that on the best chips out there. So when you're talking about innovation, disruptive changes, well, you maximize your chances of getting there faster by using the best tools out there. So I don't think that these companies will be willing to settle for cheaper options just because it costs less. But it all depends on how investors see it, of course.
Ipek, thank you so much for joining us. Ipek Ozkardeskaya, their senior analyst at Swissquote, on the very latest, of course, on DeepSeek and everything to do with AI and chips. Coming up, Trump, tariffs, and tech. We discuss all of that with our senior executive editor for Bloomberg Opinion. This is Bloomberg. So the dollar strengthened against every major currency after comments from President Trump and his Treasury Secretary renewed concerns over tariffs. Now, it follows a wild day for global markets after progress on a Chinese AI model wiped more than $500 billion from Nvidia's market cap, raising some difficult questions about America's tech superiority. Now, for more on all this, let's bring in Timothy O'Brien, who heads up Bloomberg Opinion, our commentary arm of Bloomberg News. Tim, thank you so much for joining us. Look, I'm going to call you the Trump translator because you've been following Donald Trump for over a decade. You understand his thinking, 30 years. Yeah. You understand his thinking probably more than most. The markets are lost because we don't know what's a negotiating tactic, what's policy. What do you think is Donald Trump's endgame when it comes to tariffs and policy?
Well, I think Trump's been using tariffs thus far as a negotiating tool. The question is, will he ultimately go to the mats and impose onerous tariffs? And I think that Scott Bessent is an interesting case study in that regard, because here's somebody who was, professionally born and bred on Wall Street, asset management, finance. He's at his core, he's a free trader. No one thinks imposing onerous, burdensome tariff regimes is good for trade or the economy. And if the U.S. really embraced this and really took it on full bore, it would be inflationary. And Trump got elected in part because of all the financial and inflationary pressures that landed on the Biden administration. And so they're going to have a moment where if they really pursue this to its end, it's going to have political and economic consequences for Trump and the U.S. economy at home. But Trump is not a rational actor often, and a lot of what he does is performative. He likes to be an agent of chaos, and that makes him unpredictable. And businesses and financial markets don't like unpredictability.
But so, Tim, what do you know for certain? Again, I've been told, he doesn't want a strong dollar. He's looking at the star market. Unclear, frankly, what he wants with China right now. Are there three things that you say that, this will absolutely happen or not happen under Trump?
Well, I think you can look across a core set of issues he's already engaged with, both diplomatic and financial, and he's coming out of the gates making bold claims about the use of force, whether it's military force or tariffs or diplomatic force. And I think he's waiting to see the kind of reactions he gets. You've seen a little bit of a preview of this in Colombia with, the standoff over repatriating Colombian migrants back to Colombia. And when the Colombians said they wouldn't accept them, Trump said, then I'll beat you with a tariff. And then they changed their tune. Now, Colombia is a small economy, and it's a small partner. I don't think you'll see Canada and Mexico respond the same way, or China. And those are really the three big ones. China and Mexico Canada and Mexico jointly are bigger trading and more important trading partners to the U.S. than China. And they're also proven allies. So the fact that Trump is going at two nations that share the border with the United States and are massive trading partners at the expense of both countries' economic interests is not about long-term policy. I think it's about short-term positioning.
Tim, what's Greenland about? So, I'm reading copy about, can NATO act against one of its own members if he actually goes into Greenland? Is this crazy talk?
Yeah, it's crazy talk. Both Greenland and the Panama Canal. I think also are performative. Someone got in Trump's ear and said these are emblematic of the great game, and China has an interest in the Panama Canal. Greenland has national resources. It's a passage to the Arctic. You could make a kind of rational case that somewhere in some scenario it makes diplomatic sense, but it really doesn't. And anyone who's sophisticated about this knows that. So I think the issue again is how long does he play at that game?
Who does Trump listen to on any given day? I mean, I heard, again, the chief of staff is actually very good at shutting him off. Elon Musk, I think, does not have, an office in the West Wing because of her.
Yes.
Does he listen to her, or does he listen to others?
Well, I think he listens to her about scheduling, and he listens to her about access. But remember, Donald Trump is someone who doesn't really listen to anyone else. He famously said, "I know more than the generals." He recently said he's a better judge of where interest rates should be than the Fed chairman. He likes to present himself as the final expert, and he usually is. So no one really has a final say with him, but he's got a much more tightly managed administration this time around. Yeah. I think they're trying to be more on message. They're trying to prevent random access to Trump. Yeah. People used to be able to just call him up on the phone and get him. Those days are over. But he's still not really somebody who takes advice. You
know what I heard in Davos over and over? I just don't want to be in the eye of the storm of the president, yes. Right? The chief executives are just trying to lay low.
Well, I think in Trump 1.0, the business community watched Tim Cook and how he navigated Apple's interests, especially Apple's relationship with China as a manufacturing partner, and he managed that by essentially kissing up to Trump. And on the diplomatic side, you saw Macron. He hosted Trump in Paris. He gave him a nice parade. Trump gave him a pass on some things. So I think coming in this time around, everyone's kissing the ring. The problem with Trump is once you kiss the ring, he tries to squeeze you for more.
Okay, so interesting, Tim. Thank you so much. I could talk to you for
Francine.
another 2 hours, so we'll get you back on.
Thank
Tim
you.
O'Brien there, who heads up Bloomberg Opinion, or commentary arm of Bloomberg News. Up next, Bloomberg Brief, Danny Berger and Manus Cranny in New York, and this is Bloomberg.